Oil prices have moved decisively higher since our last report, highlighting the market's bullish intentions. Today we are going to have a look at the situation in the US oil market and continue to examine issues affecting the fundamentals of the demand and supply of the international oil market. For a rounder view, we are going to conclude the report with a technical analysis of WTI's daily chart. Making a start with the US oil market, we note that Baker Hughes reported a decrease in the number of active oil rigs in the US by 2, bringing the figure down to 482 to 480. The release may have been more of a bearish side for oil prices, implying that demand levels may have dropped, forcing producers to shut down 2 rigs. Yet that picture was overturned on Tuesday as API reported a drawdown in US oil inventories of minus 2.6 million barrels. Despite the drawdown being narrower than the last reading, it still implied that aggregated demand was able to surpass oil production levels in the US and thus showing a tightness of the US oil market. That picture was verified the next day as EIA also reported a drawdown, this time even wider than the last release, yet narrower than expected. Overall, should data related to the US oil market continue to show a relatively tight situation, we may see oil prices getting further support. Another issue that caught oil traders' attention were OPEC's optimistic expectations for international oil demand. In its monthly oil market report, OPEC repeated its forecast that global oil demand will expand in 2025, largely driven by strong non-OECD growth. It should be noted that the oil-producing organization expects demand to remain high also in 2026. On the flip side, the International Energy Agency sees oil demand continuing to grow, yet at a slower pace. The France-based agency said it expects global oil demand to grow by 1.05 million barrels per day versus the 1.1 million barrels per day it forecasted last month. Yet even with IEA's moderated expectations, growth for oil demand seems to remain healthy and thus could provide some support for oil prices. WTI's upwards motion intensified since our last report as the commodities price broke the 77.85 resistance line, now turned to support, marking an increase beyond 7% in a week. We also note that the upwards motion steepened its slope, highlighting the intense bullish interest, and we intend to maintain an upwards outlook for the commodities price as long as the upwards trend line remains intact. Furthermore, we note that the RSI indicator has surpassed the reading of 70, highlighting the strong bullish sentiment of the market for WTI's price, yet at the same time may imply that WTI has reached overbought levels and it's ripe for a correction lower. Similar signals are being sent by the fact that the price action is constantly flirting with upper Bollinger Bands. For our bullish outlook to continue, we would require the commodities price to break above the 82.10 resistance level, with the next possible target for the bulls being the 87.00 resistance barrier, a level marking practically a 6-month high. For a bearish outlook, we would expect the pair to break initially the 77.85 support line and continue lower to clear break the pre-mentioned upwards trend line in a first signal that the upwards motion has been interrupted and continue to also break the 72.20 support level. Thank you for joining us today as we navigated through the dynamic world of financial news. From all of us here at IronFX, we wish you a solid trading.